Emergency podcast today, folks. It's been a wild week full of tariffs, wild stock market swings, and today the 10-year Treasury spiked above 4.5% for a little while, which means all of the work we've been doing to get mortgage rates down the last few weeks, we have just given up. Par rate is back to 7%. So what do we do? I have a plan for you. I have an idea for you. Stay with me here. We're going to work through some numbers because we're going to give you some options here. If you were a buyer that has been on the fence, that maybe got off the fence and maybe got your pre-approval in place last couple of weeks, and now you're like, oh my gosh, rate just went back up. I can't afford that price anymore. Stay with me here. We're going to give you some hope and some options. I am Rychen Jones. I'm an associate broker and realtor here in the Salt Lake City area. You have found the House Money podcast. Full disclosure, I am not a lender, and nothing we're doing here has anything to do with specific loan or loan estimates or loan amounts. This is entirely math based on a calculator. So we'll just get that out of the way right now. So what's happened right now? I have no idea. I'm not an economist, but what I can look at is that the par rate today, the free mortgage rate, if you will, is about 7.125%. We're going to call it 7% for our purposes today because that's easier math. But the 10-year Treasury spiked. Mortgage rates went back up. The interest rates, mortgage interest rates, if you want to think of it that way, are now roughly 7% before any sort of buy down or anything like that. So what are your options? You were planning on 6.5% a week ago, 6.25% maybe with a little bit of a buy down. Maybe you're looking at a 2-1 buy down. I'm going to tell you why that's a terrible idea. But what do you do right now to stay in the market, to not retreat back to the fence where maybe you've been sitting for some period of time waiting for interest rates to drop? Let me lay this out, okay? If you're listening on double speed, you may want to slow it down a little bit because we're going to talk through some numbers and you may want to take some notes. If you're not driving, do it safely. But let's just look at our 7% 30-year fixed mortgage interest rate right now. On a $500,000 loan, that's not purchase price, that's $500,000 loan amount at a 7% interest rate on a 30-year fixed loan, your principal and interest is going to be $3,226 per month for the next 360 months. That's what you know when you get a 30-year fixed mortgage at 7%. $3,226. That's going to be an important number, so we're going to come back to that. Now, what might you do if you're going to do, let's say, one of these 2-1 buy downs that have been pushed since rates started going up in March 2022? By the way, 2 years goes by so fast, and many of you, I feel your struggle right now. You've reached out to me about, do I need to sell my house? I can't afford it. My interest rate, my payment has reset to that long-term rate, and I can't afford it. What do I do? So let me walk you through a 2-1 buy down and what that is if you're not familiar with that. A 2-1 buy down is this. In the first year, your interest rate is 2 points less than your long-term standard mortgage rate. So if our rate today is 7%, the first year of a 2-1 buy down, your interest rate would be 5%. In the next year, the second year, your interest rate is 1% less than your standard rate. So 7% rate today. Our first year, our interest rate on our payment is 5%. Our second year, our payment on our interest rate is 6%. And then in the third year or the 25th month, our payment is going to reset to a payment amount based upon that 7-year interest rate and will be that rate for the next 28 years of that loan. Now, we've talked about, not we, lenders, agents, various people have talked about this idea of marry the house, date the rate. Terrible, terrible advice, because what has happened? Well, month 25 has come real fast for a lot of people, unfortunately, and they're not able to refinance because rates are not any lower than they were when they bought the house 2 years ago. They took the 5% rate the first year, the 6% rate the second year, and now it's reset back to 7, and they're in trouble because that payment is very difficult to make because they only gave themselves 24 months to possibly refinance. They're probably not ready to sell the house yet, and if they are, we're seeing lots of sellers who are struggling to sell their homes that they bought 2 or 3 years ago because they just don't have the equity to do it. We just haven't had that much of a market movement, a market shift to do it, on top of a lot of sellers needing to give buyers seller concessions so they can buy down their own interest rate. So 2-1 buy down, talk to your lender. Your situation may be unique and different, and it may work for you. But as a rule, I do not like 2-1 buy downs because that 25th month, that resetting that higher payment comes so fast, and it's so violent on a family or an individual's budget to hit that payment that fast. So what is your other option here? And stick with me here because I'm about to say a naughty word in the lending and real estate industry based upon the Great Recession. Adjustable rate mortgage. Stay with me here. Don't go away just yet. Let me walk you through this. Adjustable rate mortgages. I own two right now on a couple of my properties right now. I think they're fantastic in the right situation. So let's walk through what a 7-year adjustable rate mortgage would look like right now. Again, not a lender. We're just using general numbers here. So a 7-year adjustable rate mortgage, how does it work? It means you're going to have a fixed interest rate for the first 7 years of your loan. And then after the 7th year, after the 84th month and month 85, it's going to reset to whatever the standard par rate is, plus maybe a point, depending on how your loan is written. It's going to go up in the 85th month after 7 years. Okay. We'll get to that, what to do about that in just a minute here. But let's just look at the numbers for a minute here. Talking with some lenders today, we can get down to a 4.75% interest rate on a 7-year adjustable rate mortgage. That means that for the first 7 years, your interest rate is 4.75%. And then in year 8, it's going to adjust to whatever it's going to adjust to 7, 8, 9, 10%, somewhere in that range. But let's look through the math of that. Okay. Your payment today, that same $500,000 loan at 4.75%, your principal and interest balance on that payment is $2,608. Now remember, our 7% interest rate payment, principal and interest, was $3,226. So for a 7-year adjustable rate mortgage at 4.75%, your principal and interest payment, again, this is just math on a calculator, is $2,608. And that's going to be your principal and interest payment for the next 7 years, for the next 84 months. That's 5 years longer than that 2-1 buy down that you were so happy to take on. And your payment there starting was $2,684, $80 higher than what your 7-year adjustable rate mortgage payment will be, not for 2 years, but for 5 years. Now, I know what the question is. There's two questions that come up here. What happens in year 8? That's the first question. Let's walk through that. You're going to pay down your principal balance for the next 84 months based upon this 4.75% interest rate. At the end of that 7 years, your principal balance that you started at $500,000 is going to be roughly $437,000. Now you have a couple of options at that point. You can let your mortgage adjust to whatever the rate happens to be that day, or let's say you did a straight up refinance into a 30-year fixed mortgage. We don't know what the rate is going to be 8 years from now, but let's look at what it would need to be to get us to the same payment as if you took the 7% interest rate today. Remember, our 7% interest rate today was $3,226. 7 years from now, when our principal balance is $437,000, we could refinance at 8%, and our payment would still be less than what our payment is today at a 7% interest rate. The payment would be $3,210, so $16 less than what the payment would be today. And for the last 7 years, you've made a $2,600 a month payment, not a $3,200 a month payment. How does that compare to the 2-1 buy down? Well, your 2-1 buy down, your first year at 5%, your payment's $2,684. In year 2 at 6%, your payment is $2,997. And then when it resets to 7% in year 3, you're at $3,226. So what I'm suggesting here is that perhaps you look at an adjustable rate mortgage like this, where for 7 years, you can be at perhaps 4.75%, have a $2,600 a month payment for the next 7 years, principal and interest only. We should make sure we keep pointing that out. And then let's say you need to refinance at that point, or you refinance anywhere along the way in the next 7 years. Even if you refinanced in year 8 at 8%, your payment would still be less than what it is today at the 7% interest rate. So that's the first question I always get is what happens in year 8? The second question is, how much does this cost? How much does this cost? So for comparison purposes, let's look at the 2-1 buy down. So a 2-1 buy down on a $500,000 mortgage loan balance is going to cost you about $11,650, or roughly 2.33% of your loan, your $500,000 loan. Yeah, I talked to a couple lenders today, just wanted to run some math and see kind of what was out there. The general consensus is to get to a 4.75% interest rate for a 7-year adjustable rate mortgage is going to cost about 5 points or 5% of your loan balance. Now, that is a lot of money on a $500,000 loan. It's about $25,000. So how do we make up that balance? Well, right now, sellers are still giving, in many cases, seller concessions between maybe 1, 2, 3%. So you can knock out maybe half of it with a seller concession. Lenders right now may have some lender credits available. Maybe you can get another 0.5% lender credit. So now you're at 3. And then where does the other 2% come up? Well, maybe that's where you come up with. And maybe instead of putting down a 10% down payment, you put down a 7.5% down payment so that you can capture this lower interest rate for 7 years. Here's what you're doing. You're paying a little bit more upfront to buy down your interest rate so you have 7 additional years of safety at a lower interest rate relative to a 2-1 buy down, which only gives you protection and safety for 24 months, and then it's gone. So what I'm suggesting is at a $500,000 loan balance, if you've got some concessions from the seller and maybe your lender can throw in a little bit of a lender credit and you come up with 2 percentage points yourself on a $500,000 loan, that's $10,000. Maybe it's $10,000 less than your down payment. Wherever it is you come up with that $10,000, that $10,000 is buying you 5 years additional worth of security, knowing that your payment is $2,600 a month and is not going to adjust for 7 years. And then you run the math and look at what's my worst case scenario in year 8. I can refinance at 8%. I can maybe do another 7-year ARM at that point. So your principal balance relative to the 30-year fixed 7% interest rate you get today, your principal balance is $18,000 less. You're putting more towards principal and less towards interest for those first 7 years. I know it's a lot of math. It is. Here's what I would leave you with. If you are a buyer and you are retreating back to the fence because interest rates went up the last couple of weeks, please consider your options. You have really 3 options. One, you have the par interest rate today, which is roughly 7%. You can do a 2-1 buy down, perhaps. You can do a regular buy down, and maybe for that same money, you can get to a 6.5% rate for 30 years if that's what you feel comfortable with. Or perhaps you look at an adjustable rate mortgage, in this case, perhaps a 7-year adjustable rate mortgage with a rate somewhere perhaps in the 4.75% range that protects you for 7 years, knowing that your payment's going to be the same, your principal and interest is going to be the same for 7 years. And then you figure out a way how to finance that, how to pay for that. And maybe it means a little bit less down payment for you. Maybe it's a lender credit. Maybe it's seller concessions. If you look at the market, if you look at the demand in Salt Lake, demand is not going away. Prices are going to continue to increase. And so my advice to you is going to be figure out a way to buy a home right now. Look at your timeline, look at your situation. Don't do anything that's going to get you in trouble. Don't buy a property that you think you're going to want to sell in 2 years or 3 years, but put yourself in the best position possible with the most security as possible on your payment so that you don't have to feel forced to move because your payment resets so quickly and you can't afford it now. That's what I have for you today. It's April 11th. This is an emergency podcast. I appreciate you joining me here on the House Money Podcast. Hit subscribe, hit the rest of our content on our YouTube channel, on Spotify, on Apple Podcasts, and we will talk to you next time.